They represent you at the property level. I need those people to feel like they're the owner of that property and they worry about it.
It's when you don't communicate with them and you don't pay attention to them, that's when business goes awry.
People don't realize too that it's that interpersonal relationship you build with tenants. Then they have pride to pay you. It used to be in the time of like, you could go into a bank, if the bank guy liked you, he'd back you and give you debt.
Right.
Like now there'd be hurdles, like no one's gonna give you $100 million of debt unless you're worth $100 million, right?
Hello, everyone, and welcome. My name is Philip Palumbo. I'm the host of the Palumbo Podcast, where we interview some of the most successful founders to learn about their journey and how they got to the top. Today, we are lucky to have with us Anthony Scavo, who is president and managing partner of Basis Industrial, a leader who's reshaping the landscape of industrial real estate across America. With over 30 years of commercial real estate experience, luxury guide, Anthony has built an impressive career that began with more than 25 years at the legendary LaFroc organization in New York, where he oversaw the development of thousands of rental units, hotel rooms, condos, and millions of square feet of office space. After 2 years at Red Apple Group, where he led pre-construction on Florida's tallest West Coast mixed-use building, Anthony joined Basis Industrial in August of 2021, and the results have been nothing short of remarkable. Since taking the helm, Anthony has led Basis through explosive growth, acquiring 18 properties and over 2 million square feet of industrial product in just the first year and a half realty times. Under his leadership, the company now manages more than 4 million square feet of real estate across nearly 800 tenants, representing $500 million in industrial product. He also helped lead Basis Industrial to be recognized as the #1 fastest growing company in South Florida. Anthony, thanks so much for your time and being on the show with us today.
Thanks, Phil. Thanks for taking the time to interview me. Yes, and it's been a pretty fast path to where we are, and it's been exciting as well.
So, Anthony, as far as this fast path that you're on, what do you think the key contributor of that is?
Most of it's, of course, our team, what the industry we're in, and the growth that we're trying to drive. I mean, the idea is that we're in call it really sector-specific businesses, ground up self-storage development and acquiring multi-tenant small bay industrial. And like that term small bay, for instance, which is most of our business, has been thrown around a lot in the last 5 to 6 years. And we consider it to be really ultra small tenants, but not micro bay. Like, the tenant size is usually between 1,000 to 10,000 square feet. And most of our parks have upwards of 75 to 100 tenants. So our thing is to really aggregate this, in a business that isn't aggregated and isn't institutionalized, and try to institutionalize and aggregate it, build a portfolio of scale, and then decide what to do when we get to that scale that we're trying to get to, which is about 15 to 20 million square feet. We're about halfway there today.
Wow.
So that's what we're trying to do.
So right now, in terms of capital raising or buying these properties, so this is so Basis Industrial, so the company, how does the company make money?
We make money a couple of ways. We make money through, hopefully, when we sell, right, and we get to promote.
Yeah.
So our business is basically like a typical real estate enterprise. We have some fee income, right, because we do self-manage our assets. So we have a large management company. We actually have 55 people now. Our payroll is pretty substantial, so we're not generating that much cash flow because as you grow, Phil, I'm sure you got to hire more people. Your fee stream doesn't grow with your people stream because the people have to come before you buy assets. So, in that growth mode, you're not really where you're stable, just making, printing money. So, but me and my partners have done very well. We're all doing okay. But most of our money, hope, will come on the promote stage when we get to that point of exit, recapitalization in the future.
So in other words, so let's say you get to your goal of, you said 20 million square feet?
That's the goal, yeah.
Yep. Okay. So you have 20 million square feet. So your goal is to offload that to, let's say, like a Blackstone, Brooks, property. I mean, there's numerous options that are out there.
Yeah. Or you go public, right? You do something to monetize that event, right? That's either selling the whole portfolio, the platform. I would probably have to go work for them for a couple of years, to get that transition done. And then you'll probably cash out with a nice payday for everyone that's involved, right? Our LPs and us.
You're a founder of your current company, Basis Industrial?
So the company, my two partners, Steve Garchick and Jay Massaman actually founded something called Miami City Self Storage about 12 years ago, and 15 years ago. And we rebranded that company when I joined as a partner into Basis.
Okay, so you're a partner. How many partners are there total?
There's 4 partners total. We're all equal. Me, myself, Steve Garchick, Jay Massaman, and Dan Weinstein.
So 4 total.
4 total.
Right. So Anthony, can you talk to us about partners? So right now I'm a founder of my own firm right now. I don't have any partners, right? So it does make life a lot easier. And but obviously there are benefits to having partners too. So what is your personal view in terms of running things on your own and versus having partners?
Well, when I started, I always worked for a person. I never was an entrepreneur. I never had my own business. I mean, I've always done things entrepreneurial on the side, like, side businesses, whatever I could do just Phil, I'm sure you grew up the same way, right? 2 Italian kids from New York.
Exactly.
You're always trying to hustle as much as you can. It's a little different up here. So everyone had a little bit of that. But, mine was always, my dad worked for Lefrak for 55 years. I worked there 25, 26 years. I probably would have stayed there. Things didn't play out that way. And I went, we decided to separate ourselves and go to a different path. And I did. And I went to another billionaire family, which was Katz-Matidis in New York, Red Apple, worked for them for a little bit. And then I was like, it was my only second job ever. And I was like, before I get too old, let me see what else is out there. These guys hired a recruiter to find someone to become a partner and run their development company. I started as a small minority partner. Within a year, I was a full partner. And we totally went from just self-storage development into multi-tenant industrial and acquiring properties. And that became 90% of our business. And I ran that part of the business. So we really grew that part. So all of it wasn't planned. The partners, I give them a lot of credit and I respect everything they do just because they started this business. I joined it and became a partner. And I think as long as you have guys that see the same future, you're fine, right? I mean, listen, there's always that internal struggle of who gets more, who gets this.
Right.
You're always going to have that. I mean, listen, that's just human nature. You can't argue with that, right?
Right.
I mean, as long as everyone's humble, everyone respects what each other does, everyone respects that, what they contribute, it's fine, right? My point is, listen, I'm sure, I don't know if your listeners know about real estate, but a lot of loans you do in financing requires a lot of backing and a lot of, even if they're not recourse guarantees, when I say recourse, that means they come after you personally, or non-recourse guarantees. You have to have a lot of net worth and value. Right. So the partners help with that too, right? You need balance sheet support. You need things like that, no matter what in real estate. So either you do that with giving a piece of your business to someone, or you do it with partners, right? So my partners help in a lot of different ways. My partner Jay was an ex-broker at CBRE for 25 years. He helps find deals. My partner Steve is a guru in real estate. He helps with, call it, debt, financing, partnerships, bringing investors. My partner Dan, he deals with all the high net worth investors we have. And we have a lot of that syndicated capital that we started with. Of course, now we're moving toward more institutional capital sources just because we're growing so fast. It's hard to raise past the hat for country club money when you're doing $70 million deals. It just doesn't work.
Right.
So he, everyone does their own thing and it helps, right? And listen, my 3 partners together have done, hundreds of storage buildings. Wow. So on the storage side, they're very, that adds a lot of value as well. I never did a storage building before I came here.
So when you came in, Anthony, as a silent partner, right? You came in with, not silent partner, but you came in as a minority partner, which then you became a full partner. What did they see in you that really brought you to that level?
I think it was listen, I'm an operations guy. I've always was, right? And my 3 partners really aren't operations guys, right? They're big picture guys, and they're more of the find the capital, organizing the deal behind. And then I was this bit part of the business requires massive operational intensity. That's why, if you want to know the truth, Phil, that's why Small Bay really hasn't become institutionalized that fast, because it's the granularity of the business. Right. You have to be so detailed with listen, we have 1,500 tenants now.
Wow.
In industrial, that's unheard of, right? It's unheard of that 1,500 tenants. I mean, actually, right now we actually have 1,700 because we just closed last week on another property, right? So by the time we get to that 20 million square feet, we'll probably have 5,000 tenants.
Wow.
That's a lot of tenancy, especially when it's commercial, triple net tenants. It's not like an apartment house where everyone's paying $1,000 a month. It's easy gross rents. we're doing 5,000 cam recs. You know what I'm saying? It's a lot of work, a lot of things going on. So every tenant needs that kind of reaching out. So it's a very operational intense business. So I think that's what they saw in me, the operational side of the business. And the financial side, I just ended up, being more involved as we grew.
An operation of any business is so important. I mean, that's the that's really the key thing for you. So these 1,500 tenants. So in terms of staying on top of all that, I mean, that's why you have your 55 employees, because I'm assuming part of their role is reaching out to these tenants, making sure you're getting paid, right? And I mean,
Yep.
hopefully you're systematizing a lot of payments that you're receiving from these tenants to make it easy for the business. So just walk me through quickly in terms of managing all of those tenants.
Yeah. So luckily, as we built the portfolio, we built the management company, we built the operational side of the business, right? And listen, that wasn't easy. It was very difficult. It's still difficult now, right? Because you're always making improvements. You see as you grow what you need, what you don't need. We rolled out Yardi, which I'm sure everyone in real estate is aware of. That's a great tool to have in property management, for accounting, for everything else. So it helps you just run AR reports instantly, accounts receivable, like who hasn't paid, who has paid. And the more automation you get, the easier it is. But it's also, with the small business owner of America, you got to be talking to them. Like, I'll just give you an example. We had one property in Texas. We didn't have the right property manager there. We had to lay him off. His boss took over temporarily till we find someone new. He met with all these tenants. The property manager said two of them were leaving no matter what. They're all staying now, and they made payment plans. They're going to catch up on their rent and stay. They want someone to talk to, so their struggle, and you help them in their business, right? And we do that with every tenant. We're fine with that. Most of our tenants are small business owners. I would say 90% are. And our suite is their first stop out of their garage, right? We're like the incubator of America, right? They come to us, they can grow with us, and usually they leave us either to buy their own building or to go into a space bigger than we have, right?
Right.
We're downsizing, upsizing, contracting, expanding tenants every day. That's like 20% of our leases are either downsizing or expanding, right? So they're always staying with us. And most of them are vocal about that. But the thing is, if they have no one to talk to, they're more apt just to leave.
Absolutely.
Well, I get behind on rent, especially this type of tenant, right? The tenant that we have is more like a multifamily tenant than it is an industrial tenant. They want some hand holding. They want some one-on-one personnel. So now, all our property managers, our directors even have to visit the tenancy once a month, and they have to prove to us that they do. Proving that's a little hard, but most of them do give a report, at least some kind of detail of what they're doing.
Yeah, you know what I realized, really any business, and I just read a great book from Alex Armosi about this. And essentially, like you and I have a certain product that we're offering these people, which is a service. And the key thing though is these people want to be communicated to. When you communicate to people and you're talking to them on a consistent basis, that's how you get referrals. That's how you get that's how you get retention that becomes very, very high. It's when you don't communicate with them and you don't pay attention to them, and that's when business goes awry. So that's communication has always been for me so important. And same thing for you, as you know.
Yeah. And Phil, can I add one more thing to that? People don't realize too that it's that interpersonal relationship you build with tenants. Then they have pride to pay you.
Absolutely.
They're like, I know this person. I want to make sure. Yeah, right. I don't want to look bad. Like, you know what I'm saying?
Right.
So people
yeah.
Like that. It's a different kind of, and then they'll come to you and say, listen, I need 2 months to pay. I got to work out of, and then it's fine. We do that. We have no problem helping tenants. We don't, our goal is to get to 80% retention, and we get there after the first turn of the property. When I say the first turn, after everyone's got a new lease on us, everyone stays 80% of the time.
Yeah, that's huge. And that's all factored in your financials and when you're running all your numbers, et cetera. But, Anthony, I've been doing this 25 years. I've been doing some, a long time as well. And the key thing about business is relationships. It's relationships, communication. Obviously our service and our platform is really, really important. Obviously, that's really what gets people to come on board with us. But it's relationships by far and communication. So I want to ask you about, so you were essentially an employee for many, many years. Do you agree?
Yes.
So when you made that turn and that leap of faith, I guess, to go on more of the entrepreneurial route, tell me about the mindset of that, number one. And number two, now that you've done that, how do you feel about it?
I mean, listen, I should have probably done it earlier, but, it was.
How old were you when you did it?
45, 46. I'm pretty old.
I was 43.
Yeah. But my point is, it's not even about age. Phil, I'm talking about timing in the market, right? If I did this in 2008,
Oh, forget about it.
whatever I bought would have been gold. I mean,
Yeah.
like there was a lot of real estate geniuses in 2010 that really weren't geniuses. That's all I'm saying. Because anything you bought went up, like, it was a different time. So
Yeah.
I'm saying more like people forget. A lot of people like try to emulate people who have done really well. And a lot of people that have done really well don't just admit that it's smarts, but it was also timing, right?
Absolutely.
Like if you're lucky, some people are lucky, right? They close a fund, they raise capital, and the market crashes, so you could go do a buying spree when no one has any capital, right? It
Right.
helps a lot. And some of the biggest PE firms in the world had that luck, right? And it was just that they were probably prepared and had cash on hand for reasons, but it does help. So that was what I'm saying about younger. The age is also, listen, if you have less responsibilities, the younger you are, the better it's to start because you can take more chances too, right?
Mhm.
Now I feel like I got 55 kids plus my own kids. Like my employees, I feel like that I have responsibility to pay them. And we just had an offsite to coincide with our Christmas party when everyone comes in because we have a lot of different offices and remote locales where the buildings are. So we bring everyone together to Orlando, and I was just explaining to them, like, I feel responsible for you guys, and you should feel responsible for me, right? I want that same kind of ownership that I have for you, making sure you get paid, making sure you get bonuses to make sure me as an owner make money and you feel an owner too because you're making money. And that's what you have to. I'm just trying to instill that constantly with our employee team because a lot of them, it's not like it used to be when we were younger, right? Everyone was in one office building, everyone saw each other every day. I got guys in Dallas, Orlando, New York. We have people all over the country working. Some people are totally remote. Like some of my executives are totally remote. It's a totally different world now, and you have to deal with that.
Yeah.
And people don't realize if you're like a mid-sized company like us, I'd still consider us a small business. Some people don't, but I mean, it's a lot of money to have an office space you could put 100 people in.
Oh,
It's
yeah.
I'd rather have a property management office where my people are on property working than just have a place where they all work together.
Yeah.
So we're trying to do that, and we have about 10 offices now all over the country. And a lot of those are basically where the property management people work out of. But a lot of our whole accounting team is basically remote. And we have to deal with that, trying to build culture, trying to build like team camaraderie when a remote, and it's hard.
Yeah, the two things for me in terms of this whole work from home thing is number one, if you're younger, it's hard for you to really build relationships with the higher executives so you can move up the ladder. So I think the biggest negative by far. And a lot of these younger people don't understand that. Like, the reason why I think a lot of us got to where we are is because of mentorship and being in the same office with these people that were performing at high levels, that were older than us and more mature in the business. Now that's lost for many, many of the younger people. And the second part from us, from a business owner standpoint, is culture. When everybody's spread out in numerous places, it's more difficult to make sure that the culture is resonating across everyone. But like you said, getting everybody off campus, Orlando, you're trying to make sure you do all you can to build that culture. Because culture with companies, as you know, Anthony, is everything, right? And getting that message across.
It's more than everything. You have to build some kind of. They have to have something. They have to have pride in what they're doing in the company they work for. Right? It doesn't work. It just
Right.
doesn't. You don't want people just showing up and punching a time clock, or it doesn't work.
Right.
Especially in a business where customer relations is the biggest part of it, like in property
Right.
management, tenant or wealth management, whatever that is. You got to be the person that they're seeing,
Right.
and they represent you at the property level. I need those people to feel like they're the owner of that property, and they
Right.
worry about it.
Right.
And that's what we're trying to instill. It's a hard thing to do, but I couldn't agree more with what you're saying, Phil. Like the younger people, I get resumes today. People have been in like 6 jobs in 10 years. I'm like, I, I don't see even how you could do that. Like, I
I
get you
agree.
maybe getting a little bit more money every time, but you need a little bit of like there's that loyalty and that
Right.
working with your mentor for a long period of time to learn is gone.
Right. Right.
It's
Right.
gone. And
Right.
I don't
Right.
know if the people don't understand how important that is, how like it's just not there.
Yeah, I agree with you. I agree with you. So I want to ask you about billionaires. So throughout your career, you worked with a couple of billionaire families, right?
Yep.
So can you share with me what are they like?
They're pretty normal people. I mean, everyone was great to me. I mean, I felt like I was part of the family of Lefrak for a long time. I mean, they're great. Every one of them is a great person. Everyone in the family is a great person. I worked for the grandfather before he passed away, Sam. He was amazing. He was guy from street guy from Long Island. That's what he was, right? He built a huge business and he became a billionaire. His son Richard was amazing. His two kids were great. Richard's
Wow.
two kids, Harrison and Jamie, were great. Everyone's great. So I mean, I have nothing bad to say about anyone there. All I did was learn.
What'd you learn? What are the key things you learned from them?
Basically, just business fundamentals, right? What's important to them. I mean, listen, it is different, Phil. Like if someone wants to go to a regular real estate shop and you go from like a family in New York, because like let's be honest, New York and LA, I mean, there's maybe a couple of cities that have these families that have these real estate dynasties. There's not a lot of them. I mean, they just because you need the time, right, to build that wealth. You can't do that today. It's harder, right?
Right.
So most people have investors. So when you come from a place that, like at LeftFrag, no one ever spoke about what an IRR is. Like there wasn't, no one cared about internal rate of return. It wasn't a thing, right? Everyone was talking about how much wealth could you build in 20 years. It's a different.
Why is that? But why? So I understand what you're saying, but why wouldn't they think about that? So if they're looking to buy a 40, 50 million or $100 million property or 200, they're not looking at the cap weight, the cap return on that
You know,
property.
I mean, the more wealthy people who are trying to build wealth are probably looking at replacement costs more. If they could buy it cheaper and they could build it, or they could buy it cheaper and they could build it cheaper and they could buy it, that's what they're trying to do. Because what they're trying to do is get something that's at a value that in 10 years they could
Right.
refinance out more capital and
Right.
take that capital out tax free. It's a different kind of outlook, right? Just
Or
is.
if they're looking to do, or if they have a property they're looking to do a 1035 exchange,
Yes.
they'll buy another property, even though it's not a great property, they're still saving tons in taxes.
Yes. And then in 10 years they could refinance, take out more capital tax
Right.
free. Like, they're
Yeah.
trying to get that,
Yeah.
the remortgaging out for a tax free gain, which is a different kind of thing. I mean, listen, it's great if you stay in business long enough, you could all do that. But it's a lot of people, most investors today want money back in 5 years at most, maybe six if you're lucky. And if you have someone with a farther outlook, it could even be seven. But no one's going to stay with you for 10, 20 years till you could get those kind of gains on a property. It just doesn't happen. But you can see like the bigger PE funds are all getting those evergreen funds that don't close
Yeah.
and 10-year, 12-year outlooks. They're doing that because they know that's a safer game where you could give a bigger return and you could basically flatten out the returns over time because you get rid of market cyclical. You get rid of all the cycles when you have that kind of timeline, right?
Yeah. So Anthony, I want to turn into so a lot of people out there, they think about real estate. So they think about billionaires, they think about growth of assets, and they think, oh, real estate's the best investment. And stocks is a great investment. Many people probably would say real estate is a better investment. And I've always said that real estate's a better investment because you could really leverage real estate, right? You could buy $1 million property, put down 200,000, right? And continue to do that. And you said it before too. You have a property that's worth 50, 100 million. All of a sudden you have, 20 million of equity and you take that 20, buy another piece of property and you continue to do that over multiple generations. And that's how you have this, massive wealth accumulation. With the stock market, if I put $1 million, yes, I can margin, but margin's expensive. And if you did that, you would get these returns you get of real estate, but not many people are comfortable doing that because of the volatility of the S&P 500 and the market in general. So I guess what my question to you is if someone that's, let's say, younger that's listening to this and says, hey, I want to be the next Trump, right? I want to be the next LeFrak family, and I want to build this generational wealth in real estate. What are your thoughts in regards to that?
I mean, it's much more difficult today just because the barriers to entry is so much higher. I mean, like it's not impossible, don't get me wrong, but it's much more difficult just because, it used to be in the time of like Sam Lafrag and those guys, you could go into a bank. If the bank guy liked you, he'd back you and give you debt.
Right.
Like now there'd be hurdles. Like no one's going to give you 100 million of debt unless you're worth $100 million, right? They're going to want some kind of net worth test, something to show that you have money. So it's going to be much more difficult to grow that substantially without capital first.
Right.
So, but listen, there's a lot of guys who've become very successful in real estate who know how to raise money, get that money with them, and make money off that money, right? Make money off other people's money. We do it. A lot of other people do it. It's a good way to do it, but it's going to be hard to build that generational wealth. So, but to answer your other question about stock versus real estate, listen, leverage in either could increase returns dramatically, right? But leverage brings risk, right? And so the more leverage you put on something, the more risky it is.
Right.
Like some of my analysts are funny. They go like this, oh, look, if we have the leverage 80%, I go, yeah, of course. Make it 90. I mean, you'll get 1,000% IRR. It's great. But it
Right.
doesn't mean anything if you can't pay back that leverage, right? So you have to judge what risk you want to do or what you want to buy. Now, if someone's young and they go want to roll up their sleeves and find value add properties where you could buy it at a very good cost and there's a good coverage on your debt. When I say coverage, like the money you make from the property
Right.
is much above the debt payments. If you have that and you roll up your sleeves and you save enough money to buy 2 or 3 small multi-unit buildings, you hold those for a 5-year term, you increase the value, you flip those, then you just go to 3 10-unit buildings. By the time you're 35 or 40, you could have 50, 60 apartments you have, which is a nice little empire. And if you keep doing that over and over again, by the time you're able to leave some to your kids, you can leave them 1,000 apartments. It's not impossible. You can do that today. I mean, I'm just using multifamily because it's the easiest thing for everyone to understand. Every property type has those kind of value add opportunities. It's just that, if you want to do this for the first step, you want to go into a subsector of the industry that has a very high occupancy rate, because then you could deal with variations in the cash flow, right? You don't want something that could drop to 40% occupancy because you're not going to have money to pay the debt. Then you're going to be dealing with your lender trying to take your property,
right?
Which isn't a good place to be in. And most of the people who get the debt in the beginning are going to have to get recourse on that debt, which is going to be something personal, right? They're going to have to sign something that they're responsible to pay it. So they're going to have to take that risk too. But I think there's still a lot of opportunity. And if someone has a little help to give them in the beginning, some kind of capital to help, probably even boost them further, right? And I've seen a lot of guys. I remember, I'll just give you an example, Phil. It's easy to give real life examples for your listeners, right? Someone brought us an iOS, an outdoor storage business, to help with them and maybe bring them into bases as another vertical, right? And the guy had a really good business. He was doing 3 sites a year. He was able to lease the site before he bought it.
Oh, what is it? So he was building storage units?
No, outdoor storage. No, there was nothing there. Just buying land, putting a fence up, leasing the land to somebody. But he was able to get option contracts for 6 months, do a lease on the property, get debt, do it, right?
Okay.
And he was doing 3 a year. And I told him, listen, I said, you can't make this bigger because you can't lease it. You know what I'm saying? You can't do 20 a year. It doesn't work because you can't get 20 leases
and scale
and have these options. So I was like, you have a nice business, do it yourself. I told him straight out, you keep doing this by yourself without partners, you're going to make a nice amount of money for yourself and be fine. So if someone could do that and have a nice little, a nice little mousetrap in an industry, you should just keep doing that. Listen, you're not going to get rich right away, but you're going to build wealth and you're going to be a sustainable business for a while, which is a big thing in real estate, right? And then after that, once you build that little bit of wealth, you could do something bigger because now you have some capital.
Right. And I think the key thing with a lot of people, even when it comes to the stock side of things, or if it's real estate, because we invest in real estate for our clients as well through private funds, et cetera. And I'd love to talk to you offline about that as well. So, as far as investing with you guys, but as far as what people have to understand as investors is that you have to be very patient and you have to think long term. And it's a compounding effect. As long as you're making all the right decisions with properties you're buying and you continue to do that over long periods of time, like you said before, you'd be able to leave a nice amount of wealth for your family down the road. God willing, you live to 90, 95 years old. But let me ask you about the Big Beautiful Bill. The Big Beautiful Bill with 100% depreciation, how does that affect your business?
It doesn't really affect it affects our investors, right? A lot of them love it, because a lot of them want losses when they're getting gains from something else. So it allows us to do write off a lot more depreciation in the first year or two of the property that gets transferred down to them by the cost basis, right? So whoever has the money and whoever has the most money gets the most depreciation. It just works like that.
Right. So to just stop real quick. So for example, if you were to buy a $50 million property tomorrow and raise capital through investors, are you taking 100% depreciation year one?
We try to, if it's allowed. Last year was 80, but this year will be 100, yes.
100, yeah. So you are. Wow. So all your investors are getting that benefit.
And you do something called a cost segregation study to increase that more. So that's what we do. So those are actually pretty expensive, but they do generate a lot more depreciation you can take than using the standard formula of the IRS.
All right, so Anthony, I want to finish off this conversation with exit planning. So a big part of my firm we work on with our clients is exit planning. So really helping them understand the mindset behind that. How do you think about that as it relates to your specific industry, and how do you maximize the value of your industry? So you mentioned 20 million 20 million square feet is where you would like to be for some type of exit strategy. And I always say to people, so Anthony, it's very similar to if I said to you, hey, Anthony, you don't have to answer this, but I said, Anthony, what's your number that you need to live on in a pool of money so you can live happily for the rest of your life and do all the things you want to do, right? And you may say, hey, it's $20 million. I said, well, how'd you come up with $20 million? Well, I came up with $20 million because I just think that's the number, right? So for you, and it's perfect what you said before. So when you say 20 million square feet, is that because you backed into that number, or it's just like high level, this is how we thought about it, back of the envelope?
No, that's why I said 15 to 20 million. It could be 25. It's just when you get to that size, that's what the scale is that gets people attracted.
Right.
Like you said, the names you said before, you need that kind of scale to get the attraction of the big, call it the big PE firms, the ones that have unlimited money, or they go public, right?
Yeah.
Like a normal public REIT is about, 20 million to 25 million square feet.
Right.
And, call it, $5 or $6 billion. It would be a small one, but that's what it would be, right? So you need that kind of scale to get either public REIT exit, platform exit, something like that. Or you could always just bring in, if core money is available at that time and interest rates, right, you could always recapitalize yourself at a lower cost of capital, right?
Right.
Which helps too. I mean, if your listeners don't, that means like, you bring in, instead, if you're paying 8% money, you bring in 4% money and you transfer that money out for 4% money,
right.
And the 8% money makes what they want on their returns, right. But they stay in for a back end piece. And that a lot of people do that in this industry just because you usually could get a better valuation on a recapitalization than a sale. And the cost is cheaper, right? It just happens. So a lot of people have been doing that in our specific part of the industrial world.
Right. So another thing I talk to a lot of founders about is if you're thinking about exiting at some point, right, the operations of the business is going to be really important because as the buyers look into your operations, if it's a disaster or if it's very dependent on things like that. So as you're thinking about that 20 million square feet, do you also think about the business? Because when the buyer comes in, if they see that this business is very streamlined and efficient, that increases valuation.
Of course. I mean, you're thinking about a 75 to 100 basis point decrease in the cap rate because of the platform going with the business. You have to sell the platform or it won't work, especially in our business.
Yeah.
I mean, listen, you could sell property by property on a piecemeal sale.
No,
it could work, because that could work. Or you could sell, you could break up a 20 million square feet portfolio into 2 million square feet portfolios and curate it that way and sell it. But if you want to sell the whole thing, the platform has to go with it. And listen, at our size, we're already seeing it with different LPs and institutional investors. They want a piece of the platform. Because like they're saying, if we're going to put 500 million into your business, we deserve a piece of the platform because we're increasing your value, right? And a lot of guys say that. It just happens. That's just the way the business works, right? The bigger you get, the more money someone invests with you, the more they want in return, right? It just happens.
It's true. So for example, even with my business personally, I've had PE firms approach me wanting a certain percentage to grow together, et cetera. So when you think about an exit plan, right, whether it's fully exit, 100% sale, or PE coming in, like you said before, institutional investor coming in with 500 million, whatever it may be, what do you prefer? What are your thoughts about having a partner come in with big capital and then and having another partner essentially?
I mean, we're actually at the point right now, Phil, I don't want to give away too much, but I mean, like we're at the point right now that we've gotten too big now for like deal by deal investing, if you will, like siloed investing. So we're actually right now in talks with a couple of firms to do a bigger investment for at least, call it 1 or 2 years of business together to see how it goes. And listen, we're okay with it. It's a different kind of thing than we did, but it also allows you to deploy capital faster, grow faster, right?
Right.
So what you're trading is less freedom for faster growth, right? If you want that, you have to, sooner or later, even if you're the best fundraiser in the world, you're going to run out of rich people that you meet, right? It just happens. And and number two, if you really want to grow fast, you're not going to be able to round trip that money to get that recycled capital because the deals are still, you're still seasoning them to sell, right?
Right.
So that's what happened. That's what exactly happened with us. All our investors are very happy in the deals they're in, but we haven't been able to, sell them all or get them returns back just because we're in that, we're in the growth. We're still adding value to the properties.
Right.
So that's where we are. So we're going to probably take one of those groups and do a 2 or 3 year program with them. And then after that, usually they stay with you and keep investing if everything's going fine. And then with our stuff that we have already, we'll recapitalize that, bring it to the future, get a couple more years on that, and then have one platform, hopefully with one investor, right? So it's easier to sell and dispose of.
In regard to the commercial real estate market, so again, so we've been an investor. We took a position in commercial real estate about, I'd say, 2.5 years ago, 3 years ago, through Apollo actually. And then the idea was that commercial real estate, as you know, when rates went up back in 21, 22, to really 22, March 22, and went up the next year, really real estate got impacted in a major way. And I kind of feel like it's been more or less we're receiving cash flows, but principal has been essentially flat. How do you see the commercial real estate market now? And so the where we're investing is industrial properties, warehouses, multifamily, essentially, right? So where do you see commercial real estate going? Do you think it's getting better out there? And do we see some capital appreciation potential?
I I think what happened was, right, like everyone was living the dream from the GFC to COVID, right? There was
Yeah,
only this.
up
Okay?
until yep,
The Fed got spooked because they were giving money out for free for so long, which they shouldn't have, right? Let's be honest. They should have raised rates earlier. Everyone
100%,
knows that.
100%. Yeah,
Everyone knows that. And then COVID happened when they were about to raise rates. They're like, oh my God, what should we do? Everyone's sick.
right.
Don't raise rates. And no one expected the demand dynamic to change in the American populace. And it did, because America controls the world. I mean, I don't want to sound like just because I'm an American. Like, it does. Like they have the most, they
Yeah,
spend the most. They use the most disposable capital. So
right.
whatever they do really affects the rest of the markets in the world. It just does.
Correct.
They're a big demand driver. Our country is, because we have so much disposable capital, the rest of the world doesn't, right? So we started spending. They didn't know what to do. It changed the demand dynamic. Certain goods were in short supply. Other goods were in big supply, right? So you had a different dynamic that no one saw. That caused inflation to go up. So now they raise rates. The reason why you haven't seen real estate sell, because no one wants to sell at a higher cap rate. And people aren't going to pay a lower cap rate when interest rates are when you're borrowing at five,
Right.
6, right?
Right.
Now they're cutting rates. I mean, I think I don't know if, I'm sure you stay attuned to the press. Like Blackstone was selling massively. We bought a deal from Link, who's a Blackstone portfolio company last year. They're peeling off stuff now to print returns for their investors because now they can, right? They're getting advantageous
Absolutely.
pricing.
Right.
So liquidity is coming back.
Good.
You see the market opening, but again, you're still borrowing. Like we get very accretive term sheets from lenders. And we're like, the last deal we just did was a 5.5% fixed rate because we fixed it with a swap,
Which is great.
which is great, which is great money. Don't get me wrong.
Yeah.
But again, we have a very high yielding cash flowing property that we're buying day one. So it's easy for them to underwrite it, right? There's a lot of
But
tenants.
others are
There's
gonna be high.
yeah, you know what I'm saying? There's diversity of tenancy. There's a lot of
Yeah,
cash
yeah,
coming out.
yeah.
If you're in a big, like Apollo investing, like I love them. They're great guys. I know them too. But I'm saying they invest in big box or 3 or 4 tenants. A bank's looking like, they only got 2% rent bumps. They're going to pay a little higher rate, right? Just because.
I understand.
So
Yeah.
for them to sell, for someone to buy that from them, they have to. Most people want neutral debt or maybe a little negative or a little positive, right? So if they're borrowing at 6, you're going to sell it at 5.75 to a 6.25 cap, right?
Right.
That's probably not enough return for you guys, so they don't want to sell.
That's right.
So, but as rates drop, the market stabilizes, debt gets better. That's when it's going to open up, and time also increases value, of course.
Yeah. I mean, the most important thing is we just got to hope that the long end on the rates on the rate curve will come down, and that's the part that we're not sure about.
I mean, I honestly think I think they're going to probably cut the rate to like 3%.
I agree.
They're going to stick with that for a.
You may get 275 if the new Fed chair comes in, but I agree 275.
Well, who knows what Trump's going to put in? It might be Marita Bar. It might be someone from Fox. I mean, that'd be great. Imagine having like
then we're going to like 1. Then we're going to 1%.
Imagine we have like Sunday morning futures at the Fed, like the show would be great. That'd be amazing. Listen, I think it's funny. I tell people all the time. I don't listen. Inflation's good for real estate. I don't want to be mean, and so is lower rates. It's great.
I know.
So,
I know.
I'm
It's a
fine with what they
win-win.
want to do, but I mean, I understand what everyone's saying too. I'm not a fan of anyone. I'm just saying, like, cheaper money is better for everyone.
Of course.
Better for it opens up the housing market.
It does cause asset bubbles, though. That's the only problem with that, right? Money is too cheap, too long. That's what happened, with the '08 situation.
Well,
So it's really, it's like you're trying, you just have to manage that, right? And
Yeah,
that's why, but I think you're getting, listen, I think 3% is very reasonable.
yeah. For the SOFR rate, 3% is very reasonable. I think we'll get that. I mean, I think me and you aren't the smartest guys in Wall Street. And they're all predicting even lower, right? So I think they'll get somewhere around that. And I think that will probably be the normal rate for 6 months to a year till they see what happens. And if there's no inflation, they're just going to keep it like that. Bank lenders will charge 175 to 275 over in that range. So you'll be borrowing like, 5 to 6, which was historically that's a very good interest rate. And
you got an economy that's growing. So I think it's a good combination.
And then hopefully people will start buying houses again. The mortgage rates will open up. People, and that's what you really need. People don't realize that because that housing business affects thousands of other businesses.
Oh my gosh! I mean, we always knew that. I mean,
but people don't talk about it, right? So we know everyone knows it inherently, but like everyone's like, oh, why are like small businesses getting hurt? Because no one's building houses.
That's why I say, like, do we have the economy is moving in the right direction. There's wind at our back for numerous reasons. I won't get into now, but for numerous reasons. But
yes,
on top of that, if you add an improving housing market, which has been pretty much completely silent the past year or two with GDP where it's at. But if you start to unleash housing, right, and you only do that really with rates lower, you could see a significant rebound in the economy overall.
That's what they need rates to lower because people aren't going to buy it. Listen, it's a sad state we're in. Like people don't realize it. Like it's very hard to afford a down payment for most people.
I was just going to say that. That's like the next piece of it. The younger generation, it's very, very difficult.
No, and because they want to listen, they want to live bigger. Like it used to be, you would suffer when you were younger.
But they don't want to suffer.
No one wants to do that, and save as much as you could, and a lot of people, thank God, in our generation, Phil, the parents would help you if they had it. They would help you a little bit.
Yeah,
and a lot of the parents they are suffering a little bit. So it's a different thing going on. And they talk about all the baby boomers leaving this huge generational inheritance. Yeah, for 20% of them, it's not for 100%. People don't realize there's still that part that's that's tight. And also, people forget housing prices went up a lot because there's no supply.
Right. That's just so crazy about this situation is that there's no supply, and obviously if there's no supply and there's demand. I mean, prices continue to go up, and in an environment where you have rates that are higher than they were the past, 4 or 5 years. So it's a crazy dynamic that needs to be fixed. Not going to be easy, but listen, Anthony, this has been an awesome conversation. You're a great guy. I'm glad I got to meet you today. Look forward to staying in touch. Any final thoughts that you have?
No, thanks for that. Thanks for taking the time, Phil. This was great, and I think Ulysses had something funny to hear today. It was a good intellectual and funny.
Awesome across the board. Thanks very much. Look forward to staying in touch.
Thanks, guys.